So everyone and their mother has been talking about the bank term funding program in the financial space. Now, if you don't know what the bank term funding program is, essentially the Federal Reserve, the central bank of the United States, set up this emergency program last year on March 12th when Silicon Valley Bank failed to provide liquidity to banks in need. And it was a 1 year program. They were giving loans up to 1 year to any bank that needed it in exchange for collateral, things like bonds, mortgage-backed securities, etc. Now, that program just ended on Monday, and people are talking about it left, right, and center. Everybody in the financial space has to give their piece on it. So why shouldn't I, right? Because on YouTube, you just got to give the people what they want. You just got to make the same content as everybody else, and of course you'll get views, right? Now, I might have just dug my own grave right there, because if this gets like 5 views, that would be really embarrassing. And if it does, if you're one of the 5 people that see this, please comment some serious hate. I need to be humbled. I really do. I believe in telling people to fuck off when they need to fuck off, and I'm no exception to that. So please tell me to fuck off if I just dug my own grave in terms of the views. But in any case, people are talking about this because with banks having less access to liquidity now that the Federal Reserve is not willing to provide them these loans at par, mind you, at par, which means if I am a bank, if I'm JP Morgan Chase, and I give the Federal Reserve, let's say, $10 billion in mortgage-backed securities, I'm going to get $10 billion back from the Federal Reserve, meaning I'm going to get 100% of value. I'm not having to take a haircut on that. I'm not going to have to give the Federal Reserve that mortgage-backed security at 50, 60 cents on the dollar when it's probably worth that. No, I'm going to get 100 cents on the dollar. That's pretty big. That means I'm getting some serious liquidity, some liquidity that I probably shouldn't deserve. But in any case, since they're going to be struggling to get liquidity, or at least that's the narrative, that there's not going to be any liquidity around, that now we may see banks start to fail, starting with the regionals. You've had New York Community Bank really suffering lately. You've had a ton of bank stocks really collapsing. There's like 6 banks right now. This is only 5 fingers, but there's like 6 banks right now whose stocks are down at least 15, 20% in the past month. I mean, serious falls. Citizens Bank, a bank that I used to associate with, is down pretty heavy. Might get into a short position. Don't know. That's not on record. We'll see. But in any case, the thought here is that banks are going to fail now, that the liquidity isn't there, that they're not able to get money overnight to fund their operations. Therefore, they're not going to be able to give out loans. Therefore, if you have any sort of customer withdrawals, then boom, they're going to have to sell assets, and those assets are probably underwater because they bought a bunch of bonds, long-term bonds, at interest rates that just do not make any sense right now, with the federal funds rate being at 5.25%. And for the time being, looking like it's going to stay up there. They really don't know what they're going to do. I think they're going to have to cut, because I think the economy is going to go down the tubes. They're going to be forced to cut like they always are, 2008, 2000, 1995, etc. But who knows? They could keep it up here longer than people expect. It's really just a game of probabilities. There's no certainties, like George Gammon always says. Shout out George Gammon, because he's a great YouTuber and investor that I learn a lot from, and I really appreciate his takes and his honesty and his reliability of character. But in any case, what I really want to say about this bank term funding program coming to an end is that, first and foremost, do not let this affect your mentality. Do not let this affect your mindset. Do not let this get you down in the dumps. It could be the spark that causes a downward spiral for you mentally if you allow it, just like any negative event in the news. For instance, I made a video talking about how Pittsburgh just cut their police force. They said they're not going to respond to calls between 3 a.m. and 7 a.m. I'm here in Pittsburgh, so that affects me greatly. I also work around those times. So to see that is pretty disheartening, and I could really let that weigh on my heart and really bring me down. But I'm not going to, because I cannot directly control that right now, and it does not serve me to let that weigh me down. So don't let it weigh you down, the thought that perhaps banks are going to fail. Now, I would say this. Secondly, if you have more than $250,000 in banks above the FDIC insurance limit, I would look to diversify that. I would like to get that. I would suggest getting that in other banks. This is not financial advice, but I know that I do not have anything above $250,000 in banks. No siree. I believe that is just financial imprudence. It's pretty much financial suicide to do that, because I would not trust the FDIC to back me up for more than that. And I really wouldn't want to have too much in the banks to begin with. I don't trust them, period. But at least don't have more than 250,000, because if they fail, you will not be insured for that extra money. That is nearly guaranteed. So I would diversify that, get other banks if you have more. If you have less, I personally keep cash physically on hand so that I always have cash in the case that something does go down. In the case that either a grid goes down, don't think that's going to happen, but you never know, or just in the case that a bank does fail and you can't get deposits for a certain amount of time. You want to make sure that you can still pay your bills, you can still transact, you can still get groceries, whatever you got to do. Make sure you have some physical cash, because if you don't have it in hand, it really isn't yours. That's the idea with gold. That's also the idea with Bitcoin on a wallet. Make sure it's yours. You don't own it if you don't have your keys. It's not your gold if it's not in your possession. If it's in a vault, it's not yours. Same idea with cash. So have some on hand. The third thing is that we have to remember that the Bank Term Funding Program ended on March 11th, and they were extending loans for up to a year. So I don't believe the banks are going to start failing overnight. This is recorded Tuesday, March 12th, so this is a day after. We haven't seen anything fail yet, even though, like I said previously, there are like 6 banks teetering right now. They're small banks, they're over-leveraged. Fuck it, they should go anyways. Whatever. But to think that we're going to have some catastrophic failure in the next week, something like Bear Stearns or Lehman Brothers back in 2008, probably unlikely, though that could always come back to bite me, like so many predictors have seen in the recent past. But I don't believe that's going to be the case, because if they're extending loans for up to a year and it ended March 11th, well, technically these banks could have gotten 1-year loans March 10th, March 9th, March 8th, March 7th, and they could have been loading up over that time period. So they might have a cushion here. If any of them really are on ice, they could have a cushion before things really start to hit the fan. So that's another thing to consider with this. Also, we also have to consider that if a big bank really does start hitting the fan here, one of the major ones, like a Schwab, like a Merrill Lynch, like a JP Morgan, a Bank of America, etc., they're going to come up with another program. They're not going to let those big boys fail. Those big boys are going to be standing erect all day long, twice on Sundays. They're going to be standing erect. So don't worry about that. That's personally why I also bank with those people, because they're a little bit safer. I think that should be self-explanatory. But if it isn't, that's also what I do. But yeah, don't let it weigh on your mind. That's the first thing. Secondly, make sure you're not overly leveraged. Don't have more than $250,000 in any one bank. I would have some cash on hand as well so that you can fund your daily expenses. Oh, another tip. If you want to divest your money a little bit more, T-bills. Great option, T-bills. George Gammon suggests this. I agree with him. I think it's a great investment. Your counterparty risk is the government rather than a bank. I would rather trust the government, because that is the true question of the lesser of two evils. Which one is worse? I would rather trust the government. They're just safer. If the government goes down, the banks went down long before, my friend. So that's another thing. And then again, I don't think it's going to happen overnight. I think there's going to be more coming. I think that the writing on the wall is already there. It's already scribbled up there. But remember, those loans could have been made out Sunday, Saturday, Friday, Thursday, etc. They could have really loaded up. So there might still be quite a runway before we see this start hitting the fan. But be cautious, be wary, and keep your eyes out. If you want more news on the financial markets, on what's going on in trading, what's going on in crypto, what's going on just investing, what I'm doing personally, follow the page, because my whole motto is I'm not always right, I'm always real. I just tell you what I'm doing. You can take it or you can fucking leave it, because I'm doing it, so I have to bear the weight of my decisions, whether you do or don't. So that being said, much love, peace. I'll see you in the next video. This is New Da Vinci, out.